Good afternoon, everyone, and welcome to our new quarterly webinar series, FI Live. The format of this new series, it will include an update and outlook on the economy. We'll do an update and overview on some financial trends at our members, talk about some funding strategies, and then throughout the series, we will highlight different products and services and resources that the bank has to offer here. A few housekeeping items before we get started. This webinar is being recorded and we will send a replay link and slides out to registered attendees. And then the webinar will also be out on our public site under the financial intelligence page. If you have a question, you can use the Q&A function here in Zoom and we will get to those at the end. And then today we are offering 1 CPE credit to participants. And in order to receive that credit, you will need to participate in the polling questions. And then once the webinar is finalized, we will get you your certification in about 10 days or so. And just to introduce myself, my name is Leslie Mondesir, and I am the Marketing and Member Solutions Manager here at the bank. And I will let Drew introduce himself.
Yeah, Drew Simmons. I am the Oklahoma account manager. So I'm working mostly with our members in the state of Oklahoma, and been with the bank a little bit over 2 years now, about 2.5 years. And we're hoping to provide some valuable insight to you guys. But at the end of the day, this is kind of geared towards you. So again, if you have any questions, don't hesitate to put that out there. We'll address them at the end of the presentation. And also, yeah, keep an eye on those poll questions. We'll be able to share with you the results as we go forward. I'm going to kick things off today just talking a little bit about the economy. Right now, we've got, almost half of the way through the year. And there's a lot more questions than answers. Before I start to covering some things that are going on in the economy that we see both at the national and local levels, we'll go ahead and start with this poll question here. I'm going to back it up just one, and then that way you should see that poll question pop up on your screen any minute now. Okay, looks like it's up there. So the first question just simply answered, do you need CPE credit? That gives us an idea of who needs it. And we can keep track of that and make sure you get your certificate. I'll let you guys go ahead and populate those answers. And then down below, you can see that second question. Which area of the webinar today are you most interested in, excited about to learn about? We'll be pretty consistent as we go through these throughout the year. We're going to do them quarterly, talking about what's going on the ground level, talking about the economy, but we'll also mix it up a little bit with what might be relevant at that stage. Okay, I'm going to give you guys just a little bit longer. Looks like there's some poll questions that are coming in. Okay, go ahead and close the poll. We can see those results. So it looks like about 34% of you in the room do need that CPE credit. I'm just going to guess those are our CPA friends that got to knock that out. And then split between interested in the market and what's going on in the economy, as well as the pure analysis and member trends, about a third on each of those. So good deal. All right, well, let's go ahead and get started with what's going on in the economy. Oh, just get this pulled up here for you. Okay. Obviously, the talk's been a lot about inflation lately. Is it coming down enough? Is it coming down enough to justify maybe some rate cuts? We started the year with, I think as many as 6 or 7 rate cuts that were projected, and now we still don't have one. So the biggest question with the Fed is, yeah, they're data dependent, but are they behind the 8 ball? Seems like that they find themselves in that predicament, both in trying to slow down the economy, what they've been doing with some of their more restrictive policies of late, and also going into a rate cut type of environment. So we'll see on that. So shelter inputs are a major component of inflation, and it takes up about 40% of the CPI bucket. And that's been talked about a lot. So we'll cover a little bit on that, what's going on with housing. It's a lot is driven by supply and, of course, mortgage rates. We'll talk about that a little bit. Growth overall, pretty good. GDP came in last quarter at 3%. The Fed's preferred measure of inflation, core PCE, stands at 2.8%, core CPI at 3.6%, and the U3 unemployment rate is at about a 60-year low, 3.9%, and the underemployment rate is at 7.4%. The labor force participation rate is at 62%, not quite what we were pre-pandemic levels when it comes to the participation rate. Home price index is about 6.5% year-over-year growth, but that is down significantly from the peak in 2022 when we were at 18.5%, almost 19% there. So it is coming down a little bit, but still elevated overall. So let's go ahead and do another poll question. How many rate cuts do you feel like the Fed will do for the rest of the year? Leslie's opening up that poll. You should see it in the middle of your screen as a child window. 0, 1 to 2 cuts, 2 to 4, or more than 4. So I'll let you guys populate that. See the results here in a second. Okay, well, it looks like as these results are coming in, the lion's share of you are thinking 1 to 2 cuts. I don't disagree. That's what Fed Funds Futures is suggesting right now. Again, down from the 6 projected cuts at the beginning of the year. A few of you do feel that we won't have any cuts for the rest of the year. And based on what the Fed has been telling us up until today, there's rationale for no cuts as far as the messaging that we're getting from the Fed. And then some of you did maybe feel like we might have more than the 2 cuts, maybe something like 3 or 4. None of you answered that we're going to have more than 4. So pretty wild turnaround, right? We went from as many as 6 cuts to now down to potentially only 2, maybe even 0. All right. Well, let's kind of take a look at Fed Funds Futures. Sure enough, this is what I alluded to earlier. We started the year with Fed Funds Futures projecting as many as 6 cuts. You can see that here at the graph, as well as the projected percentage of hikes going forward. Fast forward to today, 2 cuts. So you guys are pretty spot on. I'm sure you've been monitoring this closely, but right now it's only looking like 2 cuts for the year. This is a chart of the 10-year Treasury, just going back really just a year, a look at the price action of the 10-year Treasury note. We are down about 60 basis points from the peak in 2022. Currently, the 10 years at trading around 4.41%. You can kind of see, though, lately we've been in this sort of range-bound trading of, maybe as few as it got down to 3.8% there at the beginning of the year, started climbing up, topped off at about 4.7%, has since come down to 4.4%. So as many of you know, this is an important indicator, especially when it comes to mortgage pricing. Mortgage rates are still pretty elevated. That 30-year rate's still hovering around the 7% mark. So it'll be interesting to see how and if that changes much as we progress throughout the rest of the year. As I mentioned, quarterly GDP, 3%, peaked out at 11% in 2021. Pretty stable growth since the sort of pandemic-driven levels of stimulus that was floating on in the economy. Core PCE topped off at around 5.6%. 5.6%. In February of 22, has since come down to 2.8%, but is clearly higher than where the Fed would like it to be to justify any cuts going forward. So over here, I wanted to talk about shelter a little bit because there's been a lot of talk about housing. The supply of housing is a massive issue. But how much of this is really propping up inflation? Like I said, 40% of total CPI, the bucketing, if you will, is represented by shelter. And this gives you kind of a breakdown of those items in the CPI bucket. Now, this is an interesting chart that I saw from Barry Ritholtz, who runs Ritholtz Wealth Management, great analyst, great economist. And he's really taking a look at that OER, the owner's equivalent rent component that's in CPI. And that's what the Fed is looking at here when it comes to inflation and how much of that is driven by shelter-related inflation. That's going to be this solid dark sort of blue line that you see here. And what he's doing, he's comparing that to the levels seen by Zillow's data when it comes to rent, the percentage year over year change in rents there, as well as this apartment list rent index over there in the dotted orange line. And what you can see is that those levels really peaked in 22. And there's about a 12 to 18 month difference between that and the component of OER, owner's equivalent rent, within CPI. So what that's telling us right now is that really when we're looking at CPI, and PC is the same, it's telling us, a lot of these shelter related figures, what was going on 12 to 18 months ago. Now, why is that? Why does this look much different than these other indices, and why is there such a lag? Well, there really, most of the reason is because of renewals, right? So, when it comes to landlords going out there and getting renewals from their existing tenants, they tend to try and get as close to the existing lease that they had, which peaked about, like I said, 12 to 18 months ago, as opposed to a new tenant walking in the door. Okay, that's going to be more, the new tenant is going to be more indicative of what's going on today, whereas naturally, landlords and property owners that are leasing out their properties, they're going to want to try to hang on to the higher rents. Makes sense, right? And you can kind of see that here when you compare the OER component in CPI relative to the BLS's new tenant rent index, which sure enough coincides with a peak back in 22. So that's the lag. That's what's going on here. Again, a lot of it has to do with renewals. And when you take out renewals, as shown in that new tenant index, rents are basically flat year over year. And we show that peak actually happened in 2022. Another interesting point here is, 61% of homeowners in the United States have a mortgage. And of those, 80% have mortgage rates below 5%. Current mortgage rates around 7%, and 80% of mortgage holders in the United States have rates below 5%, more than 200 basis points less than the current mortgage rate. So that's also creating some stickiness. We talked about all this, low in rates that occurred effectively in 21 and how many folks have those mortgages. But let's also not forget, we've gone through a number of, major refi cycles just in a pretty short time. It happened in 2012 when we hit all-time low in rates then. It happened again in 2016. That was more attributed to the Brexit kind of discussions that were going on at the time. And then, of course, everybody had this in their bingo card, right? The pandemic, which led to a record amount of stimulus in the economy, a record amount of dollars floating on the banking sector. And then we, of course, saw very, very low rates. So a lot of folks are out there sitting on very, very low rates, and it disincentivizes them to move. And so single house inventory is down 75% from the peak, pretty significant, right? You take, 3/4 of the supply away from the market, you're going to have a real difficult time seeing any sort of notable drop in home prices or the availability of those homes. Our regulator, the FHFA, also released a white paper on the lock-in effects, just kind of reiterating that same thing, that, really what we might want to start looking at here, if this persists, is inflation that backs out some of that housing-related stickiness that's going on. For what they found, the FHFA in their report, which we can send out a link to you guys to read, you can go on the FHFA website and find it yourself as well. But that for every percentage point that the market rates exceed the original interest rate on that mortgage, the probability of the sale decreases by a full 18% or percentage points. So that locked in mortgage rates of homes that were purchased back in 2020 and 2021 has basically caused a 57% reduction in home sales as of the last quarter of last year. And you can kind of see that graphically here. Okay. Lastly, if we do kind of what I was suggesting here, and Ritholtz does this nicely, basically just taking that same CPI number and backing out the shelter components. And really what we're seeing at 2.3%, there might be full justification if the Fed looks at it this way to have already been cutting rates, right? We're getting real close to that 2% mandate that they want to see. And especially when we back out CPI. I don't think that they're going to listen to this suggestion, but I think it's interesting, and I think it's good for us as depositories that are on the call today to get a better sense of maybe how long this could persist and the problems that might come in the wake of this light supply in the market. Okay, let's go ahead and do another poll question now that I've wrapped up my remarks on the economy. And basically, it's just asking, what is the biggest concern that you have for your local economies? What's going on locally? I've talked to many of you in Oklahoma about this, really ad nauseum, but I'd like to know just in aggregate, what's your biggest concern with the economy locally? Or you can answer nationally, but we really want to know what's going on in your neighborhood. Okay, answers are coming in here. Looks like I'm surprised. Nobody's worried about unemployment. That's not surprising. Unemployment is very, very low, which is good. And it looks about half of you. Let's see, we can share these results real quick. Are concerned about inflation. Naturally, we've seen more inflation over the last 2 years than we've had in the last 30. So understandably there, housing affordability, another big concern. We just talked about that. That's certainly a challenge. And that's, one of our mandates is to make sure that we provide home affordability options to you. And we'll cover a little bit of that later. Again, none of you answered unemployment. And I did find it interesting that there are a few of you that are concerned about delinquencies. I haven't heard a lot about that. We've maybe seen some intentional slowing down, I think, when it comes to lending. But we really haven't seen too much on the delinquency side. So by all means, reach out to us later. Let us know what you see when it comes to the credit side of your portfolio. Okay. With that, I'm going to turn it over to Leslie, and we will begin talking about some member financial trends.
Thank you, Drew, for the economic update. I've been putting together a trends report that we share on financial intelligence over the last 4 years. And this theme of uncertainty and unprecedented, those terms keep being used with the economic outlook. And that hasn't changed, but it keeps evolving. So we will continue to see where we are headed with the economy. Other headline issues or common themes that we do see across the industry. Do you want to go to the next slide? As well as within our district, continue to include those that are listed here. These kind of been the sticky headline topics for a few quarters now. I might add a slowdown in lending activity, just due to the caution for an economic downturn that Drew mentioned, as well as tightening credit conditions. Regulatory scrutiny and kind of attention, heightened focus by them could also be added to the list, especially with credit concerns on the horizon that we hear from them, along with potential for some regulation changes after the bank crisis a little over a year ago to kind of trickle down to community banks and kind of see what impact that may have going forward. We're going to start going in on the use of funds, asset side of the balance sheet here. On the left, you will have banks, and on the right, you will have our credit union members. And then the light blue bar is going to be changed in cash. Securities are going to be the darker blue. I'm sorry, securities are light blue, cash is gray, and then the loans are the dark blue. Cash has been building slightly here for bank members over the last few quarters. Credit unions have been building liquidity for several quarters now. Cash, not much work is being put into investments right now. Drew just touched on this. And then we've heard bankers across the district approach new loans with caution as the economy continues to digest higher interest rates. And reflected here is the title on the slide, loan growth continues to decelerate. And even we've seen contraction in balances at an aggregate level for our credit union members. And when we look at our members, just the percentage of banks and credit unions that saw some contraction and declines in their loan portfolios was about 45% for banks and 63% of credit unions. So a lot of our members are really seeing a slowdown in lending activity. Of the growth that we did have in aggregate for our bank members, it was led by CRE lending, followed by some multifamily lending. And on the credit union side, we did have some runoff in car and consumer loans. And interestingly, commercial balances fell for just the second time in over 7 years after posting strong, consistent growth for several quarters in that sector for our credit union members. CRE, I think, might be an opportunity to grow some relationships, of course, for those that come with deposits, for those institutions that might be underexposed or have an appetite or capacity to grow the line of business, especially from those institutions that might be wanting to offload or cap that exposure. It could be an investment opportunity for the future. New originations could be more attractive as the loan is based off of current performance and current market conditions. I've been seeing a few articles about that. Moving to the funding side of the balance sheet, again, banks are on the left and credit unions are on the right. Deposit relationships, new and old, focus is on gathering or retaining deposits. That's top of mind right now and have been for over a year as the pandemic-driven outflows were spurred by the bank crisis. Consumers were kind of woken up to higher rates, and the surge to higher yielding accounts began, not just within banks, but outside of the traditional bank products into alternative investments. Kind of led to some of that outflow and non-maturity deposits. You can also see here a shift in funding profiles, been terming out and getting longer. There's been more reliance on wholesale funding, which you can see the wholesale funding in the gray is going to be borrowing. So BTFP was established last year, broker deposits, and then of course advances. You can see that growth in the gray bar there, both for banks and credit unions. And then CDs. Retail CDs have been growing for several quarters now and now represent a larger portion of members' funding portfolios. Good news for banks and credit unions. First quarter, we had a reversal in non-maturity deposit growth. We'll see if this kind of pivot in growth continues or not. It would certainly be a welcome trend. Quarter one numbers, they're tough to gauge with tax season. So we'll see as we move here through the second quarter and throughout the year what those deposit flows might look like. San Francisco Fed recently noted that pandemic savings that were built up have finally been spent. Will they start to save again, or will they continue their spending behaviors that they've been strong spenders? And will those behaviors continue or not, and what impact what that might have as well. Term funding, I mentioned the shift in funding. Portfolios they've extended, they've got more term in them. On the prior slide, we kind of showed the whole portfolio of funding. And then here we just focus on the share and deposit composition there. On the right, you can see the non-maturities, the light blue lines, and then the darker blue are maturities. You can see after reaching a floor for composition they've kind of come back up, that dark blue line. And you can see the swing in the share deposit composition. On the left, we have maturity profiles and how those have shifted and evolved for retail CDs and broker deposits. And as customers have moved funds into those higher yielding products, the terms were short. So that light blue line or bar, I guess I should say. That's CDs, retail CDs that are maturing within 12 months. And then the gray is for credit unions, and then the other three lines are for banks. That yellow kind of pattern line, that's going to be CDs, retail CDs that are maturing within 3 months. So between the end of March and end of June, there's about 29 billion in CDs that are maturing at today's rate. And with this wave of maturities on the doorstep, deposit pricing pressure is going to persist, and it's expected to stay here for a little while before it eases, even if the Fed starts to cut rates. So with that, we will go to our first poll question. On what are your deposit growth expectations for the remainder of 2024? I will get it pulled up here. All right. You see a decline in balances, flat balances, small amount of growth, some moderate growth, or potentially some strong growth. Drew, what are you maybe hearing about economic data that might speak to kind of trends or expectations in the deposit?
Yeah, so when I talk to our members in Oklahoma, many of them actually were able to, especially some of our smaller members, were able to bring in deposits following last year's, let's call it the bank crisis that wasn't, just fears of maybe working with some of these larger regional banks. So I think that was surprising for a lot of us. I think it was obviously welcomed, but now we're kind of more a normalized type of environment. I'm not really seeing anybody do the rate kind of competitiveness that we saw last spring and into the summer. And deposits have mostly been pretty flat really over the last couple of quarters, I'd say.
All right, and I think no surprise really here, the majority of our members definitely is facing some deposit gathering retention challenges throughout the rest of the year, declining, flat, or just a minimal growth, which is going to, if there's any loan growth, there's still going to be a need for funding. Right, we'll get to our next slide. Close these poll result questions for you. And like I mentioned, deposit pricing, that pressure is expected to persist in the near term, which again is going to have some pressure on margins and earnings. That margin compression and stress is not expected to go anywhere in the near term. Hopefully we'll see some relief and hopefully hit an inflection point here in the back half of 2024 and into 2025, especially for our bank members. Credit unions, they've fared a little bit better. They're in the bottom on the left with margin performance, and the margin performance is in the dark blue line as they've lagged their bank peers in increasing share and deposit costs, which is going to be that light blue line. On the two charts on the left, the dashed line is going to be Fed Fund trend line going back a couple cycles. A few slides ago, we showed the influx of core deposits, non-maturity deposits, with non-maturity deposits balances growing, but that came at a cost for both banks and credit unions, as the growth was in interest-bearing accounts over the last 2 quarters. And that's reflected here in margin and cost of funds, certainly. On the right, we have a chart that shows 1-year CD pricing trends for both banks and credit unions in our district. We went back until December of 2022, and then the gray bars indicate the number of members that are offering a 1-year CD rate greater than 4%. And you can see how that has accelerated over the last year. Both the pace and number of institutions and the pace of rate increase has decelerated, but costs are still expected to grind a bit higher if we're going to follow past cycles. where deposit pricing does lag, even as the Fed stops and pauses, like we've seen now for several quarters. And even after rates start falling, we do see deposit costs continue to grind a little higher before they can reflect that decrease in kind of maybe market rates down, shift that over to their depositors, which would then provide some relief on the earnings side. With maturing deposits, in order to keep those deposits, you may have to pay up for market rates, both whether those go into non-maturity accounts, those rates are higher, those have continued to push higher as well, along with the shorter term CD funding. And also there's pressure on the asset side. Loan yields, especially foreign bank members, they haven't been rising as fast as deposit costs. Volume is slowing, like we talked about. Security yields, there's been a drag on earnings now for several quarters, unless there's some members that have repositioned their bond portfolios to capture some more income here in recent quarters. But otherwise, the asset side is putting pressure on earnings as well. Higher credit costs, those will be reflected as another headwind to earnings as well. And if we go to the next slide, show kind of the trend of those credit concerns continuing to mount. We have provisions there on the right on an annual basis going back a couple decades, and then net charge-offs on the right for banks and credit unions. Recently, we've seen a jump in credit costs and provisions there on the right. It's off a really low base. We haven't had a normal credit cycle in a long time. Some of that provision growth, it's related to CECL and the front loading some of that cost before losses peak. So while it might be an earnings headwind now, it should be a windfall on the back end, which will provide some relief to some of that pressure. Asset quality and coverage ratios, they continue to be pretty resilient and remain solid. Like Drew said, he's not hearing a ton, don't see a lot of concern from our members that haven't been expressed yet on the credit side. Credit unions, they're starting to see a little bit of reserve build with a slight uptick in delinquencies. On the left, we have net charge-offs on the rise. That Q1 numbers are annualized. That's why the bar is so high. But Q1, good news, was less than the fourth quarter of last year. So maybe we'll see that either maybe it's peaked or trend down a little bit or flatten out. We had a poll registration question for our annual management conference that members answered, and one of them was on regulator focus. Asset quality was listed as the second focus or topic for regulators, but not one member chose asset quality as a focus for their institution for 2022. But headlines that we continue to see across the industry express regulators' concern and attention for a credit event, especially related to CRE exposure, as we wait for potentially for the credit shoe to drop. Drew, do you have any thoughts on CRE exposures or upcoming maturities and maybe some differences between what we see within our district versus kind of the national trend?
Yeah, I mean, so much that's been covered on the national news about CRE and problems with occupancy, obviously. These are areas that are, highly densely populated metropolitan areas. And the reality is our district just really doesn't have a lot of that. We do in the, surrounding Kansas City area, of course, down in Oklahoma City and Tulsa are two largest cities in the state of Oklahoma, and of course in Colorado with Denver and some of those larger municipalities. But on average, we are out there in more of the rural communities, and that CRE is different, right? We're not talking about these loans to massive developers and things like that. We're talking about ag loans, and we're talking about small business loans and things like that. So that's it's good to not be in that company, because I really have a positive outlook on our CRE as a result of that uniqueness to the national picture. But as Leslie mentioned, the reality is the examiners are still going to really focus on it because it's such a national issue. And so we'll just need to kind of bare our teeth and get through that as much as we can on some of these regulations that come down the pike later. But yeah, overall, I think we're in a pretty good position in our district.
Yep, I agree. All right, we are going to shift. All right, on the horizon here. So just as a slide on kind of looking forward, both Drew and I have mentioned kind of the highlights or takeaways of the main themes that we expect. Kind of looking forward on the horizon with an uncertain interest rate outlook, still that caution for tightening credit conditions. Access to liquidity is still a topic for regulators. That was actually the highest answered response for our AMC poll question on regulator focus. Margin pressure here in the near term, and then market volatility. We continue to see that quite a bit, which leads in to our next topic here is funding strategies and considerations. We're going to transition now to talk about advances and a brief overview on a couple of the products that we have to offer. So looking ahead, when we think about or consider incremental funding needs, whether that's upcoming maturities or general balance sheet funding, do we look to fund short or extend funding, or maybe a blend thereof? Recent and market conditions over the last year and a half have created challenges and opportunities for our member financial institutions. Interest rate risk profiles. We've seen shifts from maybe more asset sensitive institutions going from asset sensitive to either more neutral or liability sensitive. So some funding considerations for maybe some upcoming maturities, whether that's BTFP, some brokered, some retail CDs, or even existing term advances, and general balance sheet funding. Two components or considerations would be cost and liquidity. What does the market have priced into the yield curve? What is the potential for market expectations to evolve or change over time? And what is your balance sheet need? What gaps do you need to fill? And what does your interest rate profile look like? In the bottom right, we have kind of evolution of our advance curve since October of last year. And one can kind of follow the trend from lighter to darker shading. The gray to the dark blue has been how our advance curve shape has changed over the last 7 or 8 months. So you can kind of see that volatility that we all continue to experience. From a liquidity perspective, deposit growth expectations, we talked about those. It's challenging to maintain, retain deposits. So a need for wholesale funding is likely to still be out there. Loan demand is slowing, but there might be some pockets or capacity to grow. And then organic cash flows. What does your outlook look like for asset prepayments or pay downs, security pay downs? What's that cash flow look like? And taking all those into consideration for your funding profile and what you might be looking to fill. Determining the optimal point kind of on the curve is a balancing act between those two, as well as market conditions. All right, so the inverted yield curve and implications and kind of some alternative funding strategies to consider in today's environment. We're going to talk about these 3 advanced structures and how they could all be utilized independently or together, as they each have unique characteristics or features to consider as you evaluate your funding strategies for your institution. And just kind of as you think about these strategies for your institution, and what do you think will happen with timing, direction, magnitude of rate movements? Will the Fed navigate a soft landing? Will we stay higher for longer? Will we have a hard landing with a steep drop in rates? What's the balance sheet need or maybe pain point? And what's the impact of these different scenarios on your earnings and risk profile? And how can each of these advanced types kind of help fit those needs for your balance sheet? So the first one we had listed there was bullet advances. If you have a need to borrow for a longer maturity, 12, 24, or 36 months, or do you borrow at 3 months and replace funding every 3 months with a new advance for 12 to 24 or 36 months. And if I borrow for 3 months, do I roll it to a term of 12 months? That should equate. So if you look at let me back up a second, to your chart there on the right, that's the current advance curve. And what you have, those dots are as of morning indications one day last week. You can see you have the 3 month there at 554. And then we highlight the 12 month, 24 month, and 36 month, and the difference between those rates ranging from 16 to about 75 basis points. So we have, if I borrow for 3 months and I roll it to a term of 12 months, the yield curve is kind of indicating our advance curve that should equate to 479 over time. That's what market is building into expectations today. So any funding decision that we make could be predicated on the fact of whether you think interest rate expectations have swung too far in one direction or the other, and whether you want to extend with the bullet, a longer term bullet, or you would like to consider rolling it short, both with a shorter term bullet or rolling the OLOC. If you're in the camp of a patient or wait and see with the Fed stance, what that might look like at pushing out, might consider pushing out on the advance curve. On the flip side, if you think that the Fed might swivel back, make it eager to cut rates at a quicker pace, then maybe riding the OLOC down may be more cost effective, or considering a SOFR adjustable advance may also be worth considering. And with that, we'll kind of slide over into the SOFR adjustable advance. The SOFR adjustable advance, it provides many of the same repricing benefits as the OLOC, but affords some of the benefits of a longer term liquidity profile. While the SOFR index may vary, the spread is fixed for the life of the advance when that advance is taken down. The rate for the advance is derived from adding a spread to the SOFR index. And the rate for the 3, 4, and 6 month SOFR adjustable advance was 547 last week, a 4 basis point benefit compared to the OLOC. And you can see that in the chart on the left, which that light blue is the OLOC. And then we show the 3, 4, 6 month SOFR along with the 1 year and that difference in spread. One consideration is if your institution is consistently rolling an OLOC balance, maybe consider moving a portion of that funding over to the SOFR adjustable. It can be favorable to liquidity measures with a longer final maturity, or keeping some funding online. It'll allow you to maintain some flexibility should you have deposits come in, or maybe even some cash flows from the asset side. Just another tool to add to your toolbox of funding options that you have here with us at the bank. And our third advance structure is the puttable advance. It's given the pricing or the lower pricing that you can see in the chart to the right that this offers. It does provide some margin relief through cost savings compared to those bullet advances. And there's a wide variety of structures that you can customize to fit your need. It does come with some extension risk versus contraction risk. Extension being if after the lockout period, if rates drop and then got to hold that advance either until a future option date or the final maturity. And then on the other side, contraction risk is it's called on that lockout date and then may need to look at replacing some funding at new funding costs. Since we began offering the puttable advance in April of 2023, it's been very popular product for our members. It's been an effective funding option across different combinations of lockouts and maturities for many members. Some of these are illustrated on the graph to the right. Some are extending lockout periods to reduce interest rate risk, and others are simply looking for the lowest cost funding to relieve margin pressure. We've seen final maturities range from 18 months all the way out to 15 years, and lockouts range from 3 months out to 3 years. I would say the most popular final maturity has been a 5-year. with a probably 6-month lockout has probably been our most popular option, but we've seen anywhere, like I said, it's kind of been all over depending on the institution's need for the funding and what they're trying to achieve. Puttable rates, you can see they are lower than the bullet rates because you're selling one or multiple options to us to call the advance back. Another driver of this, the pricing differential is the inverted yield curve. And other factors include the option frequency, so Bermudan or European, the length of the lockout, the final maturity date, and interest rate volatility that's being priced and perceived in the market. If you look at the chart here on the right, you can look at the 5-year, 6-month Bermudan puttable structure at 392, which is the yellow line there, the second one from the bottom, and the 6-month bullet rate at 551. Just in the first 6 months, you would capture 159 basis points of savings. And at 6 months, the bullet rate, the bullet advance, it would mature, and you would have to replace it at an unknown rate. But depending on the rate environment at this time, the put may get exercised or it may not. The differential between the puttable rate and the advance rate provides members quite a bit of a cushion to absorb a move lower in rates and still keep the all-in funding costs low, which would complement your core funding base. If a shorter final maturity term funding option is if you're considering a shorter term, that might be rolling the OLOC, rolling a SOFR adjustable, rolling short-term bullets. The question is, how far would rates have to fall in order for that shorter term funding that keeps rolling to move in favor of that strategy? If the puttable has a Bermudan option, the quarterly put option, it's embedded into the advance after the initial lockout period, and break-even rates would move along that time horizon as you come up on a put date. The shorter the horizon, the lower the break-even rate would have to be, and the more cushion you are afforded by capturing those cost savings right now. We'll kind of wrap up the funding strategy with some kind of actionable ideas to think about on the funding side. With a shift in interest rate cycle on the horizon, we offer customized advanced funding options through different structures, parts of the curve, amounts that would provide value in managing liquidity and earnings and helping hedge some interest rate risk that you might have. Cost of deposit funding is expected to remain elevated or push higher in the near term before fading. And asset yields will slowly but surely reprice higher. And when evaluating different scenarios and funding strategies, determining a break-even rate in various scenarios would help decide if the amount of the cushion is appropriate for your risk tolerance. I mentioned blended funding examples. Look at shorter term rolling options, or maybe an intermediate puttable funding. If the put option is not exercised, you have that extension. Other parts of that means rates have fallen. And other parts of the balance sheet will experience favorable reversal as well. So you'll see relief in deposit pricing likely, a recovery of market values, and asset cash flow from prepayments and paydowns that may increase. So you would have seen, although you're stuck with that advance after rates fell, you got that cost benefit for quite some time, likely, and now you're getting some benefit on other parts of the balance sheet. And then also some investment strategy. Leverage strategy has had some appeal to members in the current environment. Not only does it provide a boost to earnings now, but in the future, it could also serve as a source of asset-based liquidity. As current bond portfolios for many institutions remain underwater, and it may take a while for those to kind of get their value back. And with that, we're going to wrap this section up with a poll question to keep moving along here. And then All right. What FHL Bank advanced products have you considered, and would you consider to help fund your balance sheet? So for adjustable, puttable advance, OLOC, stay short, a combination of structures. Maybe you're not utilizing wholesale funding and don't plan to, but maybe you should consider that as an option. If there's anything we can do to help with any of these advanced analytics, or the thought process as you evaluate these strategies, please feel free to reach out to your account manager or myself, and we'll be happy to discuss with you, your ALCO, or your board, and support you in any way that we can.
Well, thanks, Leslie. Appreciate that. And I wanted to also just, on this poll question, I'd really like to see that, about half of you on the call today are using a combination of structures. One of the most common questions I get is, "Hey, Drew, what should I be doing? What are other folks doing? What do you like the most about, these different terms and different structured products?" And the reality is they all might have a place on your balance sheet. I mean, first things first, you want to consider the unique nature of your interest rate risk position. But we're happy to have those discussions, and whoever you use for your asset and liability management model, if you need to do some simulations, see what that does to your overall cost of funds and your balance sheet. But the reality is, it's just like a lot of things, diversity is king, right? And having liabilities structured on different parts of the curve, different maturities, different coupons and interest rates. That's going to give you a lot more flexibility, because we don't have that crystal ball that's going to tell us exactly when the Fed's going to start cutting rates and when they're going to stop. And in just a short time this year, that's really kind of made it an about face. So we don't pretend to know that, and so to fight that and combat it, we want to have some diversity in our liability mix. Okay, I'm going to give you a quick update just with the Federal Home Loan Bank system. We've talked about this quite a bit lately. As many of you know, the FHFA had released a report on the Federal Home Loan Bank system. So all districts in the United States looking at our mission, looking at what we're doing on the ground level with our members. This all kind of came from a Supreme Court ruling back in June of 2021 that allowed the White House administration to remove the former FHFA director and appointed Sandra Thompson as a director. So this very much politicizes the FHFA's role in how they regulate the Federal Home Loan Bank system. So from that, we saw that they really had a concerted effort to ensure that the system as a whole is achieving its mission of providing affordable housing assistance. And we're going to talk a little bit about that here in a second. We're very proud of the measures we've taken, not only just recently, but in the history of the Home Loan Bank, providing that affordable housing need, and now as much as ever. I mean, we talked about the supply issue, the affordability issue. This is all very much weighing on the minds of our members, and we're happy to do everything we can to alleviate some of those pressures. A couple of years ago, the FHFA began a listening tour. They toured all around the country. They even came to my home city in Oklahoma City, where some of our members were able to sit in and visit with the FHFA and express to them, how they use the Home Loan Bank, what they'd like to maybe even see in the future. And it was very, very much of a positive experience. And we were really, really couldn't be more proud and happy that you guys were able to show your support, whether maybe you attended any of these roundtable discussions, as listening tours, or there was a period where we had many of you show your support on their. I think they had a portal at the time where you could offer some of your thoughts on the Home Loan Bank system. So thank you to everyone who did that. A little bit more here. Right now, the support for the Home Loan Bank system has never really been stronger. A lot of that has to do with the needs on the liquidity side. So while it's important that the FHFA ensures that we are staying to our mission of home affordability, the home loan bank system is a lot different than it was back when it was created following the Great Depression. And a lot of those needs when it comes to a liquidity standpoint have increased lately, and especially over the last 2 years. We've seen, competitions on the deposit side. That's led to some challenges on your liquidity, and we are happy to meet those challenges through our funding products. The report did come with some recommended changes to the system. Keep in mind, many of these changes that they talk about would require congressional and legislative approval. So this is a big ship. It can't just be turned around overnight. From what we're hearing from our folks in DC is that there is not any interest from our legislators in all 4 of our states and nationally for fundamental changes to the home loan bank system. So that's a good thing. Your continued support is great and very meaningful. We really appreciate that. And this is an election year. Okay, so all bets are off. As I mentioned earlier, with the FHFA being such a politicized regulator at this point, I wouldn't be surprised if we see a change in the White House. I wouldn't be surprised if we'll see a change in, their sort of narrative and what they want to see with the FHFA, and probably appointing a new director as a result. But either way, we're working with all the regulators out there, with the FDIC, with the OCC, NCUA, all of them. And they're also doing a great job, talking with the FHFA and telling them, hey, look, this is a role that the Federal Home Loan Bank needs to play with their members when it comes to funding. And we're certainly not in the business of funding someone all the way up until the last minute, but we're also not in the business of turning you down. So with that, I just want to give you a little update, kind of more on what's going on the Hill nationally. This poll question is just going to ask you what concerns you might have with the future of the Home Loan Bank. Are you more concerned about changes that would negatively affect your access to our funding products? Are you concerned? There was talk in the report of maybe merging of Federal Home Loan Bank districts. I personally don't think that that's wise. And our district here in Topeka is far different than the folks out in San Fran or New York. Are you concerned with increased regulations that would increase our costs and thereby increasing your cost of funds? Wet signature requirements, that's nothing new. That's something that we're always trying to be as innovative as we can, given the box that we unfortunately have to live in. Looks like most of you guys are done. And sure enough, about 60% of the room are just concerned about anything that would negatively impact your access to our funding products. Guys, keep telling your story out there when you're talking to regulators. Keep telling them, exactly how you use us and what changes you don't want to see happen. And also, communicate with us if you want to see changes. We were always going to, kind of kick the tires and make sure that we're meeting your needs. And that's how a cooperative is supposed to work. So I'm going to move on from this poll question. We'll talk a little bit more about our community and grant programs. Okay, here we have our housing and community development programs. Many of you on the call today have used some, if not all of these. We have our affordable housing program, the AHP. We love our acronyms here at the Home Loan Bank. It's the largest privately funded housing grant program in the United States. It's been growing more and more in partnership with public and private housing development organizations. We do this. You can fill out the application for the program. It is a scoring type of program. So, if you serve kind of underserved communities or anything like that, that always helps. Turnkey is our new sort of branding for all of our suite of products that addresses homeownership across all 4 states. That includes the Set Aside program, Set Aside Plus, and our new HOPE program. The community housing program and community development program, those are basically advances that you can take advantage of that are priced below our regular advance rates when it's being used to help members finance housing in their communities and qualifying commercial loans, farm loans. economic development incentives as well. Then there's our voluntary programs. These are programs that we voluntarily provide funding to. As we grow, we've got more money to be able to set aside for those programs that we will make available to you. So this is a nice little chart just to kind of cover all of those in a little bit more detail. What's, the use of it, who benefits, how the funding works, the availability. That column there is just going to tell you what important dates are coming up for those. We recently wrapped the HOPE program that was this spring. And we've got some coming up that you need to be aware of. The application period for the AHP, for example, is coming up in July 1st. So just keep an eye out for that. And then also our NAHI program, which we initially rolled out last year with the intent to spend, I think, to provide $1 million in funding. We ended up providing $3 million. This year, we're bumping it up again to $3.6 million. So really keep your eye out for those dates when they come available. This is just kind of a kind of a visual so you can see, where are these dollars and what they go to support. All of these programs have their own unique sort of structures and what they're aimed to do. But if you have any questions on any of these programs, by all means, don't hesitate to reach out. Specifically on the NAHI, because this is so new, I just wanted to make sure we covered it. Again, applications for that open in June. And we'll close July 12th. We're going to allocate $3.6 million this year. Last year it was so new, the word might not have gotten out, but I guarantee you it is now. In my state in Oklahoma, we did quite a few of them because we have such a large tribal population in the state of Oklahoma, and they certainly are underserved areas in our communities. And it was a kind of a win for everyone really. I mean, you're, as a member, you sponsor this grant program, but these Native American tribes, they're very much used to leaning on grant programs from all different, really angles, nooks and crannies, anything that they can get their hands on, because they don't have any taxing jurisdiction. They can't just raise money through taxes or assessments or anything like that. So they do these grant applications quite often. So they're very, very much used to doing it. It's not a very painful process to go through. And at the end of the day, these dollars go to, much needed parts of our community and our tribal relationships. And it's very heartwarming to see. And we're happy to continue that program this year and into the next. So these are some just important dates and resources and links. We can, of course, send out the slides to everyone at the end of this call, so you can use that and mark your calendars. If you have any specific questions with the AHP that's coming up, with those applications, feel free to reach out to Dusty Humphreys. She is the expert in the room when it comes to those things and has all the information that you need for that. So keep an eye out for that. Okay. This I don't think we're doing that. We're skipping around here. So that pretty much wraps up our remarks today. Again, this is going to be done quarterly. Looks like we do have some Q&A questions that Leslie and I can address here in a second. I'm going to, here we go.
Real quick here, we have a screenshot of our website. Under the Resource Center, you will be able to keep an eye out for events. We will have our regional meetings posted there shortly for this fall. So be on the lookout for those, along with email communication. Also, upcoming webinars are linked there under events. I know we do a good job of getting those in email communications, but just another resource for you. This webinar and past webinars and podcasts, they're under the videos and podcast link. You can find links to those as well. And this link at the bottom of the page will bring you to this page when you get the slides.
Yeah. And so I've got, let's see here, a couple questions. Can you pull up the Q&A on your end?
Q&A we have. Can you provide any updates on wet signature requirements?
yes, that there is not an update. um, yeah, yeah, I appreciate the question, and it is, as I mentioned earlier, it is something that we are always looking into. Unfortunately, our hands are tied with some of that because that does come directly as a reg we have to follow from the FHFA. We have, we've made some progress. If you're not aware, during the pandemic, um, we allowed for some exceptions and we extended that exception for renewals. So anytime you're doing a renewal, you don't have to have a wet signature on that renewal or modification. I think is the word I need to use here. Sorry. So baby steps, but we'll certainly communicate that if we see any changes coming down the pike there. I do have a couple more questions here before we wrap. One was, is there any concerns for legitimate mergers within the home loan bank system? We certainly have concerns about it, and we definitely want to make sure that the FHFA knows how unique we, especially in our district, feel that we are. Because I think it'd be very easy for them to look at a map and say, hey, yeah, maybe Topeka and Dallas, they should probably be the same, right? They're regionally, close to each other. Well, look, I'm from Texas, and I can tell you there's a lot of similarities to Texas banking and the way financial institutions operate. There's a lot of differences. I mean, you have these massive metropolitan areas that they serve down there, and so and many of you might already be aware of this, but if you're not, each district in the home loan bank system, we do operate a little bit differently. Some offer dividends, some don't. Some don't do the MPF program that we do, and others do as well. And so, yeah, types of collateral they accept. And so we're always willing to adapt to the current environment. If we hear that another district is doing something that's pretty neat that might work for us, we'll certainly look into that. And we've done that in the past. And we've also kind of, imitation is the purest form of flattery. We've had that happen to us. Oh, you guys are doing this. This is neat. That NAHI program is certainly at the top of that list lately. So feel free to share your feedback with us. Anything that you have concerns with, do not hesitate to reach out to your account manager or Leslie directly. We're always welcoming that feedback with open arms. With that, I'll go ahead and conclude today's remarks. Do you have anything else, Leslie?
Don't have anything to add, but I think if you go another slide, of course, contact info for a variety of folks and departments that are here to help support you with any questions that you have. If you want to explore strategies, account managers are listed here. And then the lending desk is always a great resource for you as well. We have our next 2 quarterly sessions scheduled here for Thursday, August 29th and in November. So be on the lookout for registrations for that in the coming months. And with that, I think we are done for today. Thank you for joining us and for your participation. Your feedback is appreciated.
Thanks, guys. Take care.